You're listening to the Future Tech Podcast with Richard Jacobs. Future technologies such as artificial intelligence, stem cells, 3D printing, gene editing, Bitcoin, blockchain, the microbiome, quantum computing, virtual reality, and exploring space are much closer than you might think. In fact, many early versions of these technologies are in play right now, and the companies that are using these technologies are the focus of this podcast. My goal for you, the listener, is to learn from these podcasts. You may very well learn something that may change the course of your life for the better, steer you towards a new career, or give you insight into addressing a thorny medical problem. Remember, this podcast and its content is informational in nature only. No medical, tax, legal, financial, or psychological advice is being given. If you've enjoyed the podcast, please listen, subscribe, like, and tell your friends about it. Thank you.
Good morning, good afternoon, or good evening, depending on where you are calling in from or listening in the world. This is Tracy Murda with the Future Tech Podcast. Today, I have a very exciting guest. I am extremely thrilled to have Jamie Burke, CEO and founder of Outlier Ventures. Jamie, thank you so much for giving us your time today.
Hi there, it's a pleasure.
So, Outlier Ventures is obviously based in London. You're a blockchain VC firm. First of all, what time is it there for you? Are you really joining us at an awkward time for yourself?
No. It's 5:35 in the afternoon or early evening, depending on how you want to look at it.
Oh, perfect. Well, for this evening on your schedule, why don't we start off talking a little bit about I want to know about your background in the blockchain, cryptocurrency world. I've read a little bit about it, and I have some obvious questions to ask as follow-up. But why don't you give the listeners a little bit of info or bio on yourself?
Sure. Well, so the short story is that Outlier Ventures is about 5 years old now, and I set it up after becoming convinced that distributed ledger technology, these kind of scarce assets, with the advent of Bitcoin, digital scarcity, and then smart contracts were, as a kind of emerging set of tools, going to fundamentally change the web, both in terms of how it's structured with the cloud and these kind of platforms, and then subsequently society as a whole. So I kind of came across Bitcoin initially in doing some research for an investment I was making. I was an angel investor at that time, and I was looking at a peer-to-peer lending company, and that kind of led me to do some research into different kind of peer-to-peer technologies that might enable this startup, and that's when I came across Bitcoin. So that's probably just over 5 years ago, and then I went to the first Bitcoin conference in London and kind of saw this interesting, weird mix of people that were the kind of early evangelists. And I kind of, when I was looking at both the kind of participants in the space and the technology, there seemed to be a bit of a disconnect. It was very libertarian in outlook, and there didn't seem to be that many people that had much experience working with institutions and large organizations. There seemed to be a lot of idealism about how this technology might be adopted. And so my background had, prior to being an angel investor, I'd ran and then eventually set up consulting firms focused on digital innovation and change management. So I spent far too long working with incumbents and large enterprise on both trying to understand technology and emerging technologies and then adapt, and often failing to adapt. So when I kind of saw this emergent technology stack, having had that experience across multiple different industries, I guess I took a bit more of a pragmatic viewpoint that there were some things that would definitely be adopted that could be disruptive and in some cases transformative, but that how that would unfold would be very different to how many people at the time in that early community viewed it.
Jamie, what was it that kept, maybe not your interest, but when you first started out as far as staying away from, focusing on the tokenized networks, what was it that, made you look for the use cases instead? I mean, everyone else was going after the tokens, of course.
Yeah, well, the token part actually came a bit later in the journey. So, initially when I kind of committed to the space, so 5 years ago, when I said I was going to commit pretty much my every waking hour and every penny, as we'd say here, or I guess dime in the US, to this space, I knew that it would be a long cycle, and I actually set aside about 3 years worth of capital for myself and a co-founder that I brought on board, a CTO called amassed, and a small development team to kind of just get some applied learning. And I don't think anybody at that time knew how long this would take, what shape or form it would kind of manifest in when it moved away from kind of concepts into impacting the real world. So for the first probably 3 years of that, the focus was very much in quite a conventional approach, looking at companies, startups that were trying to build on top of or leverage blockchain technology to build proprietary business models. And it was only really after about 3 years, at that point we'd spoken to, I think it was about 1,500 blockchain startups from Kenya to Japan, across every different type of use case, which at that time, lots of people were very excited about the theoretical applications, and they still are multifold. The problem at that point was that the infrastructure, and still to this day, the infrastructure wasn't there. And so actually, for some of the early time, it was even pre-Ethereum. And so everyone was trying to build these proprietary business models, and we kind of looked at all these different sectors and applications and different geographies. And we became increasingly convinced that most of those weren't viable, some of them at all, and most of them within the next 5 to 10 years because of all this infrastructure that needed to be built. And so I actually did a blog post, which at the time became quite infamous, called 99% of blockchain startups are bullshit. And that was really oriented to the fact that, we saw all these people trying to raise money for startups to build at the application layer, and they just weren't viable because the infrastructure was missing. But then as we started to kind of think through, well, what business models are viable, would be viable, we became increasingly uncomfortable with the idea that in an open, decentralized web where people were building on largely the same open source code base and infrastructure, that people would be able to build startups on top of that would be able to build a moat in kind of startup parlance, or would be able to build a defensible proprietary business model, because in theory everybody had access to the same technology. The characteristics of that technology meant that industries would become more open, data would become more open, and so there seemed to be a disconnect with proprietary business models building on open source technologies that ultimately would mean, even if you could do something that was unique, the assumption was the barrier to somebody coming and copying what you're doing and doing it cheaper would be too low. And so in theory, everything would become very commoditized. Certainly if you were applying these old world principles of the platform. And so it was at that point we were kind of coming into the beginning of the ICO boom a couple of years ago, and I think that's largely because the wider industry, certainly investors, realised the same thing. They'd sunk at that point a couple of $100 million into these proprietary businesses. Nobody was making any money. Often they were kind of hemorrhaging investment and capital, and so they stopped getting finance. And so startups, almost out of desperation to try and find money, turned to the ICO as a way to raise money from the community, but potentially also allowing them to kind of open source the code base. And so almost by accident or fortune, a business model emerged for open source, which was tokenization. And that's principally because people like me stopped giving money to startups that were building proprietary businesses. And then all of a sudden, every startup that we spoke to, 90% of startups were all non-profit organizations, and they were tokenized or tokenizing. And so that was a huge shift, where no longer were people investing in equity, they're investing in tokens. And I got really excited about that. I think obviously the whole ICO phenomena went too far. The incentives were misaligned for investors, and it was often just this recycling of capital. But the principle that there could be a business model for open source, that people could raise as much money, if not more, by tokenizing an open source project than doing something in a proprietary way, was really exciting. Because if you've invested in the startup space for a long time, you'll know 90% of conventional startups fail in their first 2 to 3 years. So it's and when they fail, all code's lost, the knowledge dissipates, the team leave, and so 90%, almost 90% of capital that was going into financing this proprietary business model was being wasted, which is billions of venture and angel capital. Whilst if that capital was able to go into open source, the financing of open source networks, then what that would mean is that even if an individual team failed to execute, that the code would still be out there. People could take it, they could fork it, they could reapply it. And so it became almost biological in nature, where you kind of could evolve a code base and try different mutations and see which business model worked, or which configuration of governance model worked. And so that promised to build a much more efficient, effective, resilient startup ecosystem.
So let's talk about, I want to know who you're looking at now in terms of, or maybe kind of even along the way, the trail, the types of decentralized businesses that Outlier is looking at. What makes a good candidate for you?
Yes, it's really varied. And I wouldn't say, it's such an evolving space, and it's orders of magnitude more complex than traditional startup investing. So, on the one layer, you're investing in digital economies. And, a digital economy is much more complex than a startup, because it's in principle so decentralized. It has so many different stakeholders that need to participate in it, and because it's rooted in open source. The idea that it could be more fluid, users could move more fluidly into competing ecosystems or economies. So, on the one hand, it's an economy, and you have to look at it as a market, and a capital market, as well as kind of a commodities market, because the digital good or service that's being delivered is more like a commodity. But then alongside that, you have the governance of that. So how is that economy governed in the beginning, and how might it migrate or evolve? So should it be more centralized in the beginning, and then should it kind of dissolve into the network and have increasing levels of decentralization? You then have the technical complexity to that, which is, this is all new stuff, or at least new combinations of stuff. And so almost with every solution, you find a new problem, because effectively we are reconfiguring the internet, both in terms of the cloud, a more decentralized alternative to the cloud, and then the platform, which is the inherent business model of the internet today. So, you've got business model innovation, entirely new, unproven business models. You have the complexity of governance, the kind of rate of technical innovation, and then, the good old problems of people and founders, and are these the right people to execute this kind of mission or project? And then the regulatory component, actually, which I can't believe I almost forgot, but a lot of projects are spending millions just in legal fees just to be able to bring a token to market. And even when they do, they have had to have got comfortable with a degree of regulatory ambiguity and operating in a grey zone. So it's incredibly complex. And so as a consequence, it makes it very difficult to passively make bets and make investments, which is why Outlier Ventures is geared much more towards very active involvement in our investments. So, most VCs, even actually in our space, most VCs are a handful of people, deploying tens, hundreds of millions of capital normally. It could still be a handful of people. Each individual partner might make anything from 10 to 20 investments. And so really it's a game of numbers there. You make the assumption that 90% will fail, maybe 1% will be a unicorn, and that's how you get a return on the fund. We've kind of taken a different approach, which is because of the complexity involved in making investments for all the things that I just listed, we believe we need to have greater proximity to a project, either as an advisor, a board member, or which is more ideal, where we are kind of the lead advisor and we're actually helping them make technical decisions in the early days. We're helping them design their token economy. We're helping them think through their governance model, their pathway to decentralization. We are involving our corporate ecosystem very early and validating, is this even a problem that a customer has right now? How do they prioritize that problem? And so what we're doing is we're de-risking our investment by sweat. And so that's why we've got over 30 people compared to a traditional handful. It's why we have departments within Outlier that specialize within certain things. It's why we've got probably 10 analysts, and all they do is track the different variables from the markets generally, understanding the technology and the technology layers. We have an active competency to help in token design. So we were the first fund that I know of to hire a head of crypto economics specifically to build out a competency. And then alongside that, even once you design for a network and you've launched it, that's just the beginning. If you think about Bitcoin, it's a 10-year cycle to where it is now. If you think about any protocol like DNS or HTTP or these things that are universally adopted across the web and the internet, they often work in these 10-year cycles. And so really our focus is on this kind of post-care of a listing around the diffusion of the innovation. So we're going to spend $30 million worth of our own capital over the next 3 years just in supporting our projects and helping their innovations diffuse. So we have a DevCon where we invite all of our investments, and we've begun to develop them into what we refer to as a stack. So rather than perceiving them as this portfolio, this passive portfolio, we've begun to only invest in projects that reinforce our previous investments. Now, to many investors, that's kind of, in a typical VC world, you're looking for ideally uncorrelated investments, so you can spread the risk. But we believe so much in our thesis that we are making highly correlated investments. But the benefit to that is, with every investment that we make, they hopefully accelerate the other investments. And so we have a technical team that directly integrates the technologies of our investments in order that they are able to be adopted in combination by typically enterprise. And so we refer to this as a stack, the convergent stack, and we refer to what we do as venture as a stack rather than a portfolio.
So it sounds like, you really have an incredible just support and service of your platform as a whole. It sounds incredibly secure. Where was that? What was the obvious importance? Of course, I understand, but it seems like you really have gone out and above beyond what anyone else has done in that space, as far as just monitoring and thinking ahead, and having all these extra persons who have the experience or expertise in these certain fields. What was it that made it so important to you to have that edge?
Well, I'd like to say it was all part of the plan, but it really wasn't.
It never is.
As I said, we've been involved in space. We were the first dedicated blockchain fund in Europe, maybe one of the first in the world. And we've just been through the different cycles, and with each cycle, we learn a little bit more about space, and we realize that if we're going to deploy capital in the space, then there are things that we could do to de-risk that investment. And I guess the driver for that has been that we're also slightly unusual in that we are a partnership. So all the capital that is deployed by Outlier is the capital of the partners. So most funds are GPLPs. The GPs, 2, 3, 4, 5 people get paid to manage the money of the LPs, and often they only get paid if they're deploying that capital. And so, they want to deploy as much of that capital as possible, as quickly as possible, and they have to manage that with, this model of finding a couple of unicorns in there that cover the losses of the large majority that will fail. And that's okay if you're managing other people's money, but when it's your own money, then those decisions, you're a bit more careful. And what we realized is that we didn't want to be more careful. We wanted to take risky, big, bold bets. But to do that, the only way we could do it is by de-risking them. So the rest, they are still inherently risky, but we believed over time there are things we could do to mitigate that risk. Now, the model's still not proven, but we're definitely the only project that has reinvested pretty much all of our gains over the last 5 years. We've reinvested almost every cent or penny back into the platform, back into new deals. So, we have a thesis. We believe, if we're right, that we would have been able to invest in potentially 20 protocols that will become universal and form the backbone of the next phase of the internet. And we believe that the returns on those kind of investments are unparalleled. So we believe it's a game worth playing. And I guess one of the benefits of this asset class is that it also allows for a degree of liquidity. So we are long-term investors. As I said, we look at our investments in 10-year cycles, and often the vesting of our holdings, certainly from the advisory part of the business, vest alongside the founders for anything up to 3 to 5 years. But along the way, we are afforded a degree of liquidity, and because we are often the first investor in, we make very good returns at every stage of liquidity, and therefore we're able to take some of that liquidity, reinvest it back into the platform. And so it's actually a really great business model in that, we are unlike funds as a business, we are a profitable business. We've been profitable for the last 2 years in a row, and this year will be no different, despite the crypto winter and everything else. So we've kind of happened upon a really rare opportunity to have a highly profitable business in the short term, but also one that can unlock, venture yield that, if we're right, could be unparalleled.
What is coming down the pipe for the rest of 2019 and even into next year for you all?
So we're, by virtue of our thesis, which is called the convergence thesis, so that is the convergence of distributed ledger technology with things like IoT at the hardware layer, up to big data and data marketplaces, and then increasingly machine learning and AI. This kind of combination of technologies effectively forms what we call a new data economy, and that new data economy allows for new forms of peer-to-peer value exchange, but in a way that is protective to sovereignty of an individual. But most interestingly, that peer-to-peer value exchange is also highly relevant, we believe, to the machine-to-machine economy. And so that's where a lot of our focus goes, is how can distributed ledgers and tokens which form incentives and disincentives help coordinate the machine-to-machine economy and effectively allow for increasing levels of autonomy to be devolved to digital representatives. And so we just announced a partnership about a month ago with Smart City.Dubai, where we're looking at creating several decentralized data marketplaces to train algorithms. So, startups lack data, and often people that have lots of data, like governments or even large organizations, they lack data scientists, they lack machine learning experts. So by them, opening up their data in controlled ways to certain participants who can take that data, build narrow intelligence to optimize for whether it's mobility, energy consumption in the building, we can see this Cambrian explosion of innovation. And so for us, it's very much centered around data, but within the context of the machine-to-machine economy and how that could be tapped into by AI. So we've got several investments that we've advised, incubated, that are all coming to the market. Either they've launched testnets or live nets centered around this data economy. So Ocean Protocol is looking at creating data marketplaces to train algorithms. IOTA is an investment we made a couple of years ago, which is a protocol to enable machine-to-machine value transfer across IoT devices. We have Fetch.ai, which is looking at allowing for autonomous economic agents to live on top of ledgers to carry out transactions on behalf of people, devices. But I guess all of that is predicated on some really important principles that we believe are beginning to gain traction and where we have some positions. And one of those is self-sovereign identity, or SSI. So we have a project we're involved in called the Sovereign Foundation, so that is SOVRIN. And they've built a protocol that allows for an identity layer native to the web, but that's not just for people, but also devices and potentially bots. And so if you think about most of the things that are wrong with the internet right now, it's that we have to rely upon centralized parties to prove we are who we are and to allow us to carry out social activity or so-called peer-to-peer activity. But it's not peer-to-peer because it's mediated by Amazon or Facebook or eBay or Google. And so they built an internet protocol. They've informed many standards feeding into the World Wide Web Foundation. And they have growing adoption by partners like Microsoft, IBM, IBM Hyperledger Indie, Cisco, Deutsche Telekom, where there will be this kind of new identity layer to the internet. And I think that's the basis, because as soon as you've got decentralized identity covered, you can then unlock true decentralized web. Without that, everything else has degrees of centralization. So that's kind of our big focus for not just this year, actually, but the next several years.
Wow, that is absolutely incredible. And Jamie, I'm so glad that you were here to join us today and share all the information and updates with us. For anyone who is looking to either reach out or get in touch with your organization or with you, where's the best place to go?
So if it's me personally, Twitter probably, so at Jamie247, the numbers. And if it's Outlier, it's outlierventures.io. But we're pretty much everywhere on Telegram, Twitter, LinkedIn. It's very easy to find us.
Excellent. Thank you so much again. A big thank you to CEO and founder of London blockchain venture capitalist Outlier Ventures, Jamie Burke, giving us time today to share all the exciting and interesting information that Outlier is up to. Jamie, come back again soon and let us know how things are going the rest of the year.
Will do. Thanks for having me.
All right. Thanks so much. Have a wonderful day.
You're listening to the Future Tech Podcast with Richard Jacobs. Future technologies such as artificial intelligence, stem cells, 3D printing, gene editing, Bitcoin, blockchain, the microbiome, quantum computing, virtual reality, and exploring space are much closer than you might think. In fact, many early versions of these technologies are in play right now, and the companies that are using these technologies are the focus of this podcast. My goal for you, the listener, is to learn from these podcasts. You may very well learn something that may change the course of your life for the better, steer you towards a new career, or give you insight into addressing a thorny medical problem. Remember, this podcast and its content is informational in nature only. No medical, tax, legal, financial, or psychological advice is being given. If you've enjoyed the podcast, please listen, subscribe, like, and tell your friends about it. Thank you.